$300, 48 hours. That is the scale of the move gold has already made this week, and the event that determines the next $300 move arrives while markets are completely closed. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, gold is at $4,132 and the recovery is stalling. Iran has officially denied that productive negotiations exist. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. Iran's Foreign Ministry, March 25, 2026. Iran has officially denied that the talks President Trump described as very good and productive represent any genuine diplomatic engagement. Gold at $4,432 per ounce is attempting to stabilize. It is failing. Today's intraday range is $4,307 to $4,148. That is a $141 swing inside a single session. This follows a $300 move in 48 hours. Gold collapsed to approximately $4,100 on Monday, March 23rd, as Middle East escalation fears drove oil higher and the dollar firmer. Gold reversed sharply toward $4,148 on Tuesday, March 24th, when President Trump announced a 5-day postponement of any Iran strike. Today, Iran's official denial has killed the recovery. The timing is what deserves scrutiny, not the reversal itself, the timing. Iran and the United States are issuing directly contradictory public statements simultaneously. Both cannot be simultaneously true, and markets are beginning to price that fact. The March 28 ceasefire deadline is a hard calendar event. It does not move. Think about what that sequence actually means. Markets close Thursday evening U.S. time. They reopen Sunday evening. Whatever resolves, or does not resolve, between Thursday close and Sunday open arrives as a gap. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time gold moved $300 in 48 hours on a geopolitical binary event, the Sunday gap that followed was larger than any single intraday move during the event itself. The gap is where the real price discovery happens. Let's build it out. Now let's build the full picture because Iran's denial does not exist in isolation. Gold's current level of $4,132 is approximately 21% below its January 29, 2026, all-time high of $5,594 per ounce recorded on COMEX. Silver at $71 to $73 per ounce is approximately 40% below its January 29 all-time high of $121.67 per ounce, also recorded on COMEX on the same day. The gold-to-silver ratio today stands at 66.9. Historically, when gold has recovered from geopolitical-driven sell-offs of this scale, silver has outperformed on the recovery. The ratio compresses towards 60 or below. That compression has not started. Silver is still lagging materially. At the same time, the Shanghai Gold Exchange physical silver benchmark continues to price at approximately $78 to $79 per ounce. That is a $5 to $8 premium above COMEX spot silver right now. Physical buyers in Asia are not waiting for Iran to resolve before pricing real deliverable metal. The rate of that divergence is not narrowing. It is holding. The data is doing the talking. The ones who were told the physical paper divergence was noise, they are not saying much right now, and here is what makes that picture even harder to ignore. COMEX. April silver first notice day is 4 business days away. As of today, 9.1 million ounces remain open in the April delivery position. Against that, COMEX registered deliverable silver inventory stands at only 103 million ounces, against 429 million ounces of total paper open interest. That is a 4.2 to 1 ratio of paper to physical. At the same time, institutional desks running long April silver positions that do not want delivery are rolling from April into July contracts right now. That rolling pressure, selling April, buying July, may create modest paper price weakness Wednesday and Thursday that is entirely distinct from the underlying supply picture. That is not a contradiction, that is the setup, and before anyone takes that as a clear directional signal, setups of this kind routinely take longer to resolve than markets expect. The timing of the resolution is a completely separate question from the structural reality of the setup. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. March 28th, that is the hard deadline. 2 trading sessions away. Now the Iran situation, because this is no longer a backdrop, It is the primary variable. Iran's foreign ministry has issued an official public denial of productive talks as of March 25, 2026. The United States' position, stated by President Trump, is that conversations have occurred and are meaningful and productive. Those two positions are mutually exclusive. One of them is wrong. The March 28 ceasefire deadline expires in 3 days. If Iran formally rejects negotiations before Friday, oil reprices above $115 to $120 per barrel. The DXY dollar index breaks above 101. 10-year Treasury yields push toward 4.6%. Gold gaps lower toward $4,100 to $4,000 on Sunday's open, retesting Monday's collapse level. Silver gaps below $66, potentially reaching $62 to $63 on forced paper liquidation. Markets are still pricing residual hope for diplomatic progress. Look at the DXY at 99.66 and tell me what probability you are assigning to Iran reversing its official public position within 48 hours. When markets start pricing the reality of what Iran's foreign ministry is actually saying, gold reprices lower. Silver reprices lower and faster given its higher beta. That is the historical pattern. Every time a hard geopolitical deadline has arrived without confirmed diplomatic resolution, it has not been different yet. Gold Western COMEX spot at $4,430. Intraday range today $4,300 to $4,148. Shanghai Gold Exchange physical silver at $78 to $79 per ounce. A $5 to $8 documented premium over COMEX paper silver at $71 to $73. The short-term picture is the most binary I have seen in this market cycle. If Iran confirms meaningful engagement before Thursday close, dollar falls below 97, gold gaps to $4,700 to $4,800 Sunday open, silver gaps toward $80 on geopolitical relief combined with COMEX delivery short covering. If Iran formally rejects negotiations, gold retests $4,100 to $4,000, silver hits $62 to $63, and the registered inventory drawdown that follows becomes a future squeeze setup rather than an immediate recovery. That is the only short-term read that matters right now. As for positioning into a weekend binary of this scale, I cannot see a clean directional trade on the lower timeframes going into Thursday's close. I cannot tell you what gold does Sunday. Nobody can. If you think you know, good for you. Gold at $4,132 is a more defensible hold than leveraged silver at $73 given gold's deeper institutional liquidity and lower beta. But holding leverage positions through a gap this asymmetric is not analysis. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this weekend gap have a real case, and the one you ignore into Thursday close is the one that will cost you. So let's run both. The bear case is real. Iran's foreign ministry official denial of productive talks on March 25th makes a clean diplomatic reversal before March 28th, a low probability outcome based on available evidence. A failed ceasefire sends oil above $120, DXY above 101, and gold gaps to $4,100 or below on Sunday open, retesting Monday's collapse level with no liquid market to hedge in real time. Silver's 40% drawdown from January's 121.67 all-time high accelerates towards $62 to $63 on forced paper liquidation as leveraged longs exit before April 1st notice day. The bull case is equally real. A surprise diplomatic framework announced before Friday sends DXY below 97 and gold to $4,700 to $4,800 on Sunday's open, the largest single gap higher in this cycle. Silver's SGE physical premium of $5 to $8 above COMEX establishes a structural floor that Asian physical buyers defend, regardless of the geopolitical outcome, preventing the full liquidation scenario. COMEX registered silver at 103 million ounces against 429 million in open interest means any gap higher in silver triggers simultaneous delivery short covering, amplifying the move materially beyond the geopolitical relief alone. Size correctly. Know what you are in before you are in it. The physical market is already pricing $78 to $79 for silver in Shanghai. The paper market is pricing $71 to $73 in New York. That argument does not last forever. The entire setup I showed you today resolves in one direction or the other by Sunday's open. The $300 move already happened inside liquid trading hours. The gap that follows a hard geopolitical deadline, arriving into thin Sunday liquidity, has historically exceeded the intraday moves that preceded it. The structural pressure is already built into the data. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group COMEX data at cmegroup.com, Shanghai Gold Exchange at sg.com.cn. Federal Reserve FRED database for DXY and yield data at fred.louisfed.org. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.